Today's webinar hosted by A&G Chartered Accountants, a member firm of ATH Catalan, IFRS 18 in practice, policies, presentation, and performance. My name is Sehrij Bhatti. I am CA and ACCA, currently serving as Assistant Manager in the advisory service of our firm. So over the last 2 decades, IS1 has been the backbone of how entities present their financial statements. However, one consistent concern raised by investors, analysts, and regulators has been the lack of comparability and clarity in reported performance, particularly around operating profit and management adjusted measures. In response to this, the ISB issued IFRS 18 in April 2024. So, marking one of the most significant presentation reforms we have seen in recent years. Today's session is not about theory, it's about what actually changes, why it matters, and how finance teams should start preparing now. Let's crack down IFRS 18 with some associated buzzwords like MPMs and SMBAs. Without delaying further, I would like to introduce our esteemed speakers from our financial advisory and assurance teams at ATH Catalan. First, we have Ms. Khushbu Mushtaq, who is the Regional Director, Advisory at ATH Catalan. Khushbu is a Chartered Accountant and UACA and serves as the Chairperson for the UAE chapter of ICAP. She brings extensive experience in advisory engagements across IFRS implementation, financial reporting transformations, and complex accounting matters. Today, she will help us connect the intent of IFRS 18 with its practical implications for organizations. Joining her is Mr. Ammar Hussain Kati, ACA, Associate Director at ATH Catalan. Ammar is a seasoned audit and finance professional in accounting, assurance, and advisory services. He has worked closely with organizations on regulatory compliance, financial statement presentation, and governance matters. In today's session, Ammar will walk us through the key structural changes under IFRS 18 and what they mean for performance reporting and comparability. We are also joined by Mr. Ihtisham Iftikhar, a chartered accountant serving as an assistant manager in the financial service advisory at ATH Catalan. Ihtisham has a strong background in audit, accounting, and financial advisory with extensive experience in applying IFRS requirements in practice. He will be supporting the discussion with implementation insights, practical examples, and considerations for finance teams preparing for transition. With that, I'll hand over to Ms. Khushbu Mushtaq to begin the session.
Assalamu alaikum, everyone. Good afternoon. Thank you very much, Sehrij, for a wonderful introduction of the entire team and setting the ground of today's webinar. So ATH Guideline and A&G Chartered Accountant has been bringing webinars in the past for IFRS. And today we are going to unlock or share with you our insights about IFRS 18. I have with me Ammar and Ihtisham. We are going to set some ground rules. The idea of today's webinar is we'll take the Q&As at the end. Probably there won't be any Q&As because the idea is to share practical information or practical knowledge that we have come across in our advisory practice, as well as our discussion with our fellow chartered accountants and accounting professionals that what issues have been raised when we plan to implement IFRS 18. So today's agenda, Ihtisham, if you could go to the next slide. So we'll start with the objective and the scope of IFRS 18, why, what, when. Then we'll unlock the key differences, what IS1 had and what we are bringing more on the table, what IFRS 18 is bringing. Then we'll move towards the key requirements of the standard, which is very detailed, very comprehensive. We'll share our insights, we'll share the requirements of IFRS, what IFRS says, why things have been implemented, what are the practical issues that people are facing. So bits and pieces. And then we'll discuss the effective date, transition, and a little bit about what measures you or entities should take today so that by the time it is implemented, you guys are ready. So that's the ground rule, how we are going to take it forward. Next, please. So let's start with why and what. Why IFRS 18 was introduced. IS 1 was already there. People were comfortable, people were happy, financial statements were being prepared properly. Then what was the need of IFRS 18? So see, the rule is very simple. IS 1 was for the preparer, how you are going to prepare the financial statements. But what IASB thought, and based on the discussion with various investors, they were facing difficulties, the investors especially, to compare the financial information of one or more entities. For example, there was one entity, there was one industry with two different entities, two different financial statements, but similar industry, similar operations, everything was similar. But their financial statement says or shows different line items, which becomes difficult for a normal user to interpret them when they are taking their decisions. Hence, based on the request of investors, IASB thought that now it's high time we should think about the users as well. So IFRS 18 is only bringing the changes that will affect the user. Although it will bring some additional efforts on the preparers, I agree, but the ultimate motive or objective is to make a decision maker life easy. So this is the basic objective of IFRS 18. What is the scope? Now, there are different kinds of financial statements being prepared worldwide. Someone is preparing annual financial statements, someone is preparing interim, condensed, someone is preparing special or specialized financial statement. There are different kind of audits going on. So there are different kind of financial statements being prepared. What IFRS 18 is asking us to do, all the companies, all the entities, implement or adopt the IFRS 18 on general purpose financial statements. That's it. So if we put it this way, general purpose financial statement means all the all the annual reports. All annual reports needs to have the implementation of IFRS 18. Simple. Let's keep it simple. For example, if there is a non-profit organization and they are supposed to prepare financial in a certain way, like they don't show their operating profit, they show their surplus. So is it important for them to adopt IFRS 18? No. They are a specialized kind of financial statements. You have to implement IFRS 18 on general purpose financial statement. Let's keep it very clear and simple. So this is the scope. Objective is also very clear. This is only for the ease of decision maker, and that's why IFRS 18 is being implemented. Next, please. Okay, so what are the changes? I can see someone saying that my voice is very low. I hope that's not the case. Anyway, let's do again. So what are the changes that are coming up with IFRS 18? I'm sure many of you would know that IFRS 18 is bringing mandatory subtotals. And on which statement? The major statement that is being affected is statement of profit and loss. So the statement of profit and loss right now shows only profit before tax, tax, and then profit after tax, correct? Now, what IFRS 18 is bringing on the table is, as a preparer, you need to disclose at least two subtotals. And those subtotals are basically classifying different categories or bringing different categories on your profit and loss statement. If we just compare the table, statement of profit and loss in IS 1, they say there is no category, which I just said. You are sharing your revenue, your gross profit, your expenses, your net profit. But now IFRS 18 is asking you to classify your profit and loss account into mandatory categories and give a subtotal also. What are those categories? It wants you to identify what is your operating activity as an entity. What are your major operations? Show the user everything, all the expenses and income from your operating category. Then they want you to segregate your investing categories. Whatever the companies is investing, the income and expenses from that investing category will show in this particular area. And then the third part that they want us to do is the financing category. So whatever financing expenses and income are generated, they want us to show it separately. What people usually tell me, okay, this is the same thing what cash flow is being, we have been preparing indirect cash flow in the same manner. I would say yes, but there are some exceptions to it. We will discuss. And there is one more thing that is bringing, that is very qualitative or very judgmental, where it requires a lot of efforts from the preparer, the consultant, as well as the auditor. That area is management performance measures. So what is MPMs? If you'll go through the IFRS is bringing a new concept of MPMs. MPMs is in IS1, there was no requirement of disclosing MPMs, showing MPMs, working on the MPMs, but IFRS 18 is strict about that if an entity is disclosing their MPMs or is sharing their management performance measure anywhere in the annual report, then that particular MPM required to be stated as a disclosure in the financial statement. And they also want you to prepare a reconciliation of those subtotals which you have actually created on the face of the P&L as in the categories as per IFRS and this MPM. And now why is that so? So just take a step back. My colleague will explain in detail what MPMs are and why is it, how you are going to disclose it. But for example, there is one MPM which is EBITDA, okay, which is disclosed anywhere in the financial statement. Not even the financial statement, let's say in the annual report, in director's report, or any other communication that the company is spreading out. And there is one word, EBITDA is X amount. So what ISB wants us to do, that you have to give a reconciliation of that EBITDA to your operating profit, which you are calculating as per IFRS, or to any other subtotals which you are calculating as per IFRS on the face. So now this reconciliation becomes very important. So this is a new concept that ISB has brought us. Then there is one more thing, aggregation and disaggregation.
Khushbu, I so sorry to interrupt, but I just to our audience, what Khushbu just mentioned, that the management performance measures. This is an interesting part of IFRS 18. So just hold your horses, and in my turn, we'll run through this MPMs. So for now, just having an helicopter view, what Khushbu just mentioned in terms of the key changes and the differences between IS1 and IFRS 18. But this is a new concept within IFRS 18, so just wait for the best part. It comes towards the end.
That's very important. Thank you, Amar. So let's go to aggregation and disaggregation. What IS1 used to say that try to concise information as much as possible, disclose information, whatever is feasible or whatever the preparer thinks important. There were general principles. Aggregation, disaggregation means clubbing things or disclosing one line item in different categories. But IFRS 18 is very particular that now you cannot show one line item saying others or miscellaneous, and you can put everything that does not fit in any other criteria. So they are very strict about this requirement. Why? Because the user is ultimately taking a decision on these numbers that you're disclosing and the categories that you're disclosing. So there is one example I heard about was, let's say in others or in miscellaneous expenses, there is a penalty amount of 1 million dirham, and the entity has not disclosed this as a penalty amount. So will this impact the decision of the user? Of course, right? If this would have been disclosed properly, then the user would have thought differently about taking a decision on this financial statement. And the user, I don't always mean the public user, there are even private companies, the board sitting, the management sitting, everyone is the user of this financial statement. So aggregation and disaggregation is another category that Etasham will highlight why and how we are supposed to aggregate and disaggregate. And the last statement out of all the all the components of the financial statement, what are the other impacts that IFRS 18 is bringing? So we already spoke about statement of profit and loss. There are few changes that are being required on the balance sheet and the cash flow and the notes. Those changes are not very material, but they will have an impact on the face of the balance sheet and the cash flow. So there are a few more changes implemented by IFRS 18. So that's a high-level summary of what changes our IFRS 18 is bringing for us to adopt. So now I think we can request Etasham, the expert on the IFRS in my team. He's going to take us through sorry, Etasham, can you please move to the next slide? So Etisham is going to discuss what are the key requirements of IFRS 18, and then I'll jump in wherever I need.
Yes. Thank you, Khushbu, for the great setting of the landscape and giving the audience a brief idea of what we are going to explain them in the session. And we'll be explaining the standard in a bit overall holistic view. And if there are questions, we can definitely take up in the chat and we can answer those at the end of the session. So what we have done for now is we have distributed the whole standard into 6 sections. IFRS, ISB distributed the whole standard into 132 paragraphs. We have taken those 132 paragraphs into 6 sections. So first section is related to the general requirements of the financial statements. Second section is related to the statement of profit or loss. And the third section is related to the comprehensive income. Similarly, statement of financial position and statement of changes in equity. In the last, there is a 6th section that is related to the notes, which will cover the MTMs that Khushbu talked about. And we'll have a great discussion about those. That's a new thing that ISB has added in this standard and in overall the appearance of the financial statements. So discussing about the first section, when we talk about the first section is more or less similar to what IS1 was giving us. Like we will be publishing and preparing the whole set of the financial statements that includes the 4 statements and the notes, and then the notes are would be explaining whatever is presented on the face of the financial statements or in the financial statement line items. They will be giving the breakup of those. Then the new part in this section is the aggregation and disaggregation principles that were absent in IS1. So IFRS 18 is like focusing very much on the standardization of the financial information that is being presented on the in the company's financial performance reports and overall the financial health of the company. Aggregation and disaggregation principles, basically they like Khushbu explained the materiality concept. They are working based on the materiality concept. Earlier, this was not the case. You can add anything in the others category or miscellaneous category if that's not a huge number. Like you can say, if it's not more than 5% of the total of that category, you could put it in the miscellaneous or other category. But when we discuss about the materiality concept also takes into account the qualitative materiality. So like Khushbu explained in her example, if there is a fine or penalty, fines and penalties by nature or material, so they are to be presented separately if they are material to the user's decision making. That's one thing in important and the update in the first section. The second section, that's a complete overhaul of the financial statement of profit and loss. IFRS 18 has introduced 2 new categories, which are investing and financing, and included mandatory subtotals, that is operating profit before loss, profit and loss before financing and taxes. So, and There is also a choice in presenting the expenses according to the function or according to their nature. So this section has a clear changes in it, and we will be discussing these in detail in the later slides. Then there is the other comprehensive income. There is not much of a change in statement of comprehensive income. It is retained as it is, presented separately with the profit and loss, or presented combined with the profit or loss, or presented, it can be presented separately. Then comes the financial position. There are minor changes in the financial statement of financial position. We'll discuss that in the later stage. And then there is statement of changes equity. Not much of the changes in statement of changes in equity. And there is a the last section that we have created for understanding is the notes. Related to the notes, in the notes, the significant changes relate to the structure of the notes, the management defined performance measures, how they will be calculated, how they will be presented, what are the related disclosures required for those management defined performance measures. And then there are some additional disclosures relating to the capital structures of the company and how the capital structure would be defined, and what would be the objectives of the capital. So this is the yes.
Atisham, sorry to interrupt you. If you can just bring the mic near to you, I think so. Some of our audience are having some difficulties in terms of listening. So
yeah, do let me know if it's better now.
Sure, please. Thank you.
So overall, we have discussed what we will be covering in order to get a holistic view of the IFRS 18, and let's move on to the each section. Basically, we have taken out the important section, that is section 2 for us, and the last section, that is the notes section. And the major focus is on these two sections. So let's move on to the statement of profit and loss, and how the profit and loss statement is structured, and how we can ready ourselves for the upcoming financial statements preparation process. So in the statement of profit and loss, IFRS 18 has recommended 5 categories on the face of the profit and loss. Of these categories is the investing category, is the financing category, is the discontinued operations category, and the income taxes. So there is a 5th category called operating, that is the residual category. So first of all, the preparers have to identify what's going into the investing activities, what's going into the financing activities, what's going into the discontinued operations, income taxes, and whatever is the residual would be going into the operating expenses. So in operating expenses, the general expenses that would be going there are all income and expenses that are related to the core business activities of the entity. Like if the entity is a manufacturing entity, it's a manufacturing of a snack, like it's a food, it's in the food business or in the snacks business, anything related to the sale of those products or the purchase of the raw materials would be going into the operating categories. Employee benefits that are related to directly the production or the factory of that entity would be going into the operations activity. Marketing, admin expenses, all those expenses would be generally going into operating expenses. There are some other things that could come into this area, but for now, it would the general examples that would be going into this category are the ones explained just now. So in the investing and the financing activities, these are the important activities. Like we have to determine how the expenses will be going into investing and financing. Right now, into the investing categories, the income and expenses are related from the subsidiaries, the joint ventures, the associates that will be going into the investing activities. Any gains or losses on the assets that are independently generating revenues for the entity would be going into the investing activities. Dividends or interest received on cash or cash equivalents would be going into the investing activities. So you would be seeing that it's a non-main activity. That's another concept that we'll be discussing in the later slides. upcoming slide, but it's an important concept, so we'll be definitely discussing that. Then there comes the financing activity. You guys might be very well aware of what would be the financing category. Anything related to the financing of the liabilities would be coming here. Either it's the interest expenses or any liability that you have incurred just for the financing purposes would be coming here, or let it be dividends, let it be interest charges, whatever that can be, that will be presented in the financing category. This financing and the investing category has a special point to them that would be discussed in the upcoming slide. But let's just hold on that for now. In the discontinued operations, there would be a single line item explaining what are the results of the discontinued operations. This is similar to what IS1 was giving us, and then there comes the income taxes. So any tax that is let it be deferred tax or the current year tax expense that is going to the profit and loss as a single line item as income taxes. So let's just move on to the next slide.
Etisham, I would like to share whatever you said, a little bit an extension to it. So can you go back to the previous slide? What I want my audience to understand in the investing activity, because this is an add-on thing that we have to disclose in the financial statement on the face. So as Etisham said, whenever you are classifying your operating, financing, or investing activity, you have to consider what is the core business activity of the entity from which you are actually generating incomes, correct? So when you do that, you can classify your related line items in individual categories. The key point or the rule of thumb should be from where that line item or from, okay, just understand the underlying income, expense, asset or liability of that transaction. Okay, wherever is it generated from, you have to classify in that particular category. But there is a very, very difficult kind of exception to it, for which few of the companies would not be happy about, especially if there's core business activity is investment. So why I'm saying that? Because there is an exception in the standard that you have to disclose the share of profit and loss from your associates or your joint venture if you are accounting them for as per equity accounting. So in that particular accounting mode, if you have any income or expense, like a share of profit or loss, you have to classify it in your investing category, no matter if your business is investments in different subsidiaries, associates, and JVs. Why I'm saying that companies won't be happy? Because their operating profit will not include the share or loss from that particular associate or JV. Hence, your operating profit usually would be reduced, correct? Because that particular line item is not a part of your investing category. It will be a part of, it won't be a part of your operating category. It will be a part of your investing category. Hence, your operating profit on which there will be different MPMs, there will be bank covenants attached to, there will be performance measures, bonus, whatsoever, different, that operating profit will be a base to many measures that company will be dependent upon. So if this line item is an exception that you cannot classify it in your operations, no matter you are a holding company or an investment company, if in that case, you need to think now how you are going to change the parameters on which you are basing this operating profit on. So this was one thing that came across in my practical examples, what I've been facing and what I've been sharing knowledge with different professionals. So this is something that we all need to be very aware of, that this is an exception. You cannot undo this. This is what it is. Okay. I'll share more examples. Thank you. Over to you, Etisham.
Yeah. Thank you, Kushbu, for taking the pause And let's just move on to the next slide. So the next slide would be talking about what would be the structure of the operating category, how we will be categorizing the expenses in the operating category. So earlier, there was no such detailed guidance on what is going on the face of the financial statements and what is going into the disclosure. And IFRS 18 was very strict, like you have to keep the minimal things on the face of the profit and loss statement. Now, IFRS 18 has given us the much of the flexibility, and we can categorize the expenses by according to their nature, according to their function, or a mixed presentation. So what we mean by when we discuss the nature, nature means any expense according to the use of the economic resources that has happened to bring the revenue for the company to affect the cash flows of the company. Like for example, if there is an expense, an IT company which has an internet or something like that, utilities expense, we can categorize in the on the face of the profit and loss statement according to the utilities section, and we can add a line for utilities, we can add a line for research and development expenses, these type of things we can add on the face of the profit and loss statement according to the nature. Or if we want to go, if the it is more suitable to go by the function is like whatever that expense is supporting, like if it is supporting general admin expenses, if it is supporting the manufacturing of that item, then it's going as cost of goods sold. We can definitely do that too, and we can have a mixed presentation too. So mixed presentation means if we want to go by cost of goods sold, we can add cost of goods sold, and then after cost of goods sold, we can add general admin expenses. And from that general and admin expenses, we want to show some expenses like there are utilities expense, there is a payroll expense that is significant expense from the general admin expenses or cost of sales expenses. We can present that expense separately. This flexibility was not provided by IS1, and IFRS 18 has guided us how we can do that, and how that would be helpful for a specific industry. This is just to standardize the industry practices. If someone in the car manufacturing business, they would be presenting in a similar way, and the comparability would be easy between one or two companies or with the previous periods of the same company without disturbing the categorization. So these are some examples how we will be categorizing that by function or by nature for a mixed presentation. So generally, impairment expenses were not presented on the face of the profit and loss, or and in the but IFRS 18 in the mixed presentation allows you can take out some expenses. If you think this is a material information, then you can present it on the face of the profit and loss. That's just relating to the operating category. Now moving on to the next slide. There comes a concept of specified main business activity that is pretty much related to the two sections that we were discussing, financing and investing. This specified main business activity is specifically described in the whole IFRS 18 and a very judgmental area for the companies to have a decision on this in order to categorize their incomes and expenses into investing or financing activities. What is a specified main business activity is the company or a group has to determine what is their main business activity. If that main business activity comes to fall in the investing category or the financing category, like a leasing company, like a manufacturer of cars, providing financing along with that selling or distribution of those cars, then this comes a specified business, or we can take examples of banks. They are coming into this, they have the specified main business activity, or a holding company that whose business is to provide financing to its subsidiaries or to its associates and earn the money from that. Then it comes to a specified main business activity. But that's just a specified business activity, not a specified main business activity. For main business activity, companies has to assess whether this is a main activity or not. So like for a holding company, If we take an example of a holding company that has invested in its in the retail business, in the food business, and also is involved in the leasing of cars, then what would be the main business activity of that company? Would it be the retail section? Would it be the leasing car company or other manufacturing business? What would be the main business activity? Companies will have to spend some time, some resources to assess how they are going to determine what is the what is going to be their main business activity. Based on that specific main business activity, that holding company will be categorizing its incomes and expenses into investing or financing activity. For example, if we determine or that company determines that the leasing company, the leasing part, the leasing for the holding company or the group, the leasing part is a significant activity and this should be the main business activity, then most of the expenses from investing and financing activities would be going into the operating category for that company.
Ehtisham, I just want to add in this, especially for us being in the UAE itself and within this region. So just to give an example to our audience, that when it comes to just to understand from everybody's perspective, we can take an example of major family offices or family businesses here in the UAE and overall in the GCC as well, where they have basically different activities under different entities. They are into at the holding level, they have other operational activities or main business activities, and at the subsidiary levels, they have different investment in different businesses, automotive, trading, manufacturing, and so on and so forth. So just to understand the concept of specified main business activities within the standalone level and at the consolidated level, we can just take a picturization of the family offices especially. So that just for an understanding, and even I think so going onwards in this concept within the main business activities itself, it will give you a better understanding overall. So Ehtisham, please. Thank you, buddy.
Yeah, thank you, Umar, for shedding some light on this relating to the real examples. So that's why the specified main business activity is important, because the classification between operating and investing activities is going to be relied upon that decision, and this would be the crucial point in determining the operating profits and the other measures that company is going to be evaluating for to use in its annual reports or some other information that's going to be published. So that's one concept, and let's move on to the next slide. The next slide discusses the minor changes that we have in the statement of financial position and the statement of cash flow. So there is not much change in the statement of financial position. Everything is retained and like reinforced under IFRS 18. The only one criteria is goodwill is to be presented as a separate line item. Earlier, this was a choice whether to be presented in a separate line item or to be merged with other intangibles. But now IFRS 18 has mandated to present goodwill in a separate line item. The next thing is the statement of cash flows. In the statement of cash flows, there are two major changes. One of them being the operating profit, the starting point for the cash. And the other change is the choice to present interest and dividends. Earlier, according to IFRS 7, this was a choice to present interest paid and interest received in either operating or financing activities, and dividend received and dividend paid in either operating or investing activities. But IFRS 18 has taken a strict stance on this, and everything is going into the specific category. Like interest paid would be going into the financing category, and the dividends paid would be going into the financing category, and any income received in the or dividends would be going into the investing category. These are the major changes that are to be incorporated in the statement of cash flows and statement of financial position. As we earlier discussed that in the statement of changes in equity and the comprehensive income, there are not major changes to discuss. So we haven't taken that in our whole discussion and the presentation. So that summarizes the major changes other than the management defined performance measures. For this section, I would like Amar to take up the lead and explain how we are going to determine the management defined performance measures, how will they impact the financial statements, and how they are going to be considered while during the audit process of those financial performance and those MPM. Thank you, Amar. Can you please take up?
Thank you, Etisham.
Thank you once again, and good afternoon and assalamu alaikum to our audience, everybody. Those of you who don't know me, my name is Amar, and I'm an humble auditor with our firm A&G Chartered Accountants. I'm heading the function as an associate director, and we were more than glad for all of our audience to be on this webinar on this busy Tuesday afternoon. Sometimes it's good for a change to have a webinar on IFRS 18 in the middle of the day. I think so it's quite refreshing for everybody, and we have kept you engaged all across. Just a quick recap to what Khushbu and Ehtisham have just run through the topics. So speakers have well defined the objectives and scope of the standard, key differences from IS1 and the rationale for change and related key requirements. How will the statement of profit and loss will look? What are the categories and what companies need to do if they have specified business activities? And especially how are different classifications being done, and how and what the statement of financial position and statement of cash flows may be impacted within the standards. So like when Khushbu was presenting, I just barged in and mentioned the terms MPMs. So this is a terminology after implementation of IFRS 18. All of us finance professionals will be hearing these terms along with the other terms the IFRS 18 has defined. So before hopping on to MPMs, obviously we all know from the previous slide what MPM stands for. Okay, so MPM first of all, MPM stands for Management Defined Performance Measures or Management Performance Measures. So let's first just simply dissect it, that what exactly MPMs are. I hope everybody is listening to me and I'm audible enough in terms of the mic and everything. So in very simple terms, an MPM, you can say first, I'll run through the definition, what basically the slide presents, but in very simple terms, an MPM is a profit or loss number that the management creates or basically presents to explain its performance in its own way. Okay, not defined by IFRS, not prescribed. It's just the management's own way, how exactly they present it within its official communication, but which is not a required IFRS subtotal within the financial statements. Okay, so and if what basically, as per the definition, the MPM is a subtotal of income and expenses. I'm reading on the slide itself, so you can just follow on the slide. That is used in public communications outside financial statements. Some of the examples are press releases, investor presentations. The examples, even you can see, these are formal communications and written communications from the management to the public. And it communicates management view of an aspect of the entity's overall financial performance, and is not a specified subtotal in IFRS 18, what just I mentioned in the beginning. So now, let's have some key examples in which just we can all recognize exactly that how MPMs basically will be presented in the slide itself. So some of the examples are, or maybe an adjusted operating profit, which can be adjusted for share-based payments, an adjusted EBIT and EBITDA as well. So these are some examples just for an understanding overall that how you can bifurcate between IFRS prescribed subtotal and what an MPM is. Now, quickly hopping on to the fact that why exactly IFRS 18 introduced these MPMs. Previously, there was no need within the IS1 or how did the board come up with an idea of MPM itself? So even in the beginning as well, Khushbu just mentioned that what exactly the purpose was. The purpose was again the idea from different investors and how exactly the financial statements is being viewed or can be viewed, and the necessary decisions can be taken at the FS level. So again, a very simple question as a professional: why did IFRS 18 step into this area? So, like I mentioned that before IFRS 18, companies were already using these measures widely, okay, in an annual reports, in investor decks, press releases, and other recognized official written communications where the companies were sending official messages to the public. But there were no consistent rules regarding them or as how to treat and report them. But now, again, IFRS 18 has clarified exactly what needs to be done. And going onwards within the topic, I'll explain exactly what needs to be done from the management perspective. I'll, again, in the middle, wear my auditor's hat. And from an audit perspective, what MTM, what significance MTM holds, and how we can go about it. So, frankly speaking, IFRS 18 does not stop management from using these measures. Okay, it only tells us that if you are using them, explain them clearly and consistently. That's it. That's the main purpose of getting into this. So, and based on this fact, we can take this that this is an IASB's direct response to, like I said, that years of feedback from different users of financial statements, investors, about non-GAAP or any adjusted measures, things like EBITDA, underlying profits, or any core earnings that the management frequently highlights in their releases or investor decks. That needs to be basically linked or correlated with what they disclose in the financial statements as per IFRS. So under IFRS 1, there were no specific rules. Again, to reiterate, just I'm giving you a recap. So, which sometimes led to any selective adjustments and reduced comparability. So this was the major setback in IS 1, which IFRS 18 is filling this gap within this. A quick disclosure requirements in the financial statements, just something obviously that will be required in the FS. So when an MPM is being disclosed, so the explanation and the purpose and when the calculation methodology needs to be disclosed. A very important thing, I think so in the previous slides also we ran through the reconciliation part, that how the MPMs will be reconciled to the closest measured as required by the presentation of the IFRS. And basically all the MPMs disclosures needs to be disclosed within a single note. I hope everybody is following on this. And basically it's not getting, because this is the good part of IFRS 18, by the way. Okay, apart from the very dry area that it is, but in terms of the new thing that it presents, this is the new thing in IFRS 18. So now we have mentioned that what exactly an MPM is or what MPMs are. Now let's run through what is not an MPM. Okay, and this is again, I'm wearing the auditor's hat, and from the company's perspective as well, that what is not an MPM. Okay, number one, so IFRS required subtotals. That includes operating profits, that includes profit before tax, profit for the year. These are not MPMs, okay, which come under the purview of the IFRS itself. The other important thing is ratios. Ratios does not constitute to MPMs. Ratios can be EPS, ROE, or EBITDA margin. So EBITDA can be an MPM, but the margin, EBITDA margin, cannot be an MPM. Okay. And the interesting part now, the last 2 points. Number one is the oral communications. So from the beginning, I've been very clear that written official communications, which are basically communicated to the public in a formal way, okay, in terms of investor deck, in terms of press releases, which are official. Any oral communications, which can be an earning call, which can be a verbal presentation to investors or to third parties, are not part of an NPM, okay. And last but not the least, the best part, social media posts. You might write something on LinkedIn, you might tweet it, or in our age, obviously, even big people, everybody knows, I won't mention them, but now are going on social media, be it Twitter, be it other forms, and that might be considered their official communication, but from an IFRS perspective and MPM perspective, those social media posts are not considered as MPMs. So IFRS 18, again, to reiterate and go on the next topic, is that it only focuses on written public communication and where you provide performance numbers. Okay, and it might not be whatever and however the management says. Okay, management can say 1,000 things in their communication, but it should be formal, it should be relevant, and it should be performance based. Now, I think so. Whatever we have run through in the previous topic itself. Now, just quickly, the implications for the management or the preparers of the financial statements and the auditors, especially for us. As in, if I tell myself regarding that what impact it will and what needs to be considered. Again, we might consider the main business activities, what are the practical applications, and how it needs to be addressed, how it needs to be audited. Okay, so there are practical implications included in this as well. Now, coming to the reconciliation part, I'll quickly run through it. Obviously, the purpose of this webinar was to give you, frankly speaking, a very high level and important updates within the IFRS 18 as well. Obviously, here in the UAE, one of the big telecom entities have already implemented IFRS 18, and they have early adopted it. But going onwards, every organization, I think so, needs to focus and dive into what exactly it requires. So from the reconciliation part, whenever an MPM is disclosed, a clear reconciliation to the IFRS subtotal is required to the MPM. Okay, this is the first and the foremost important part. Again, from an auditor perspective, and with my background in assurance, that what scrutiny and what audit effort might be required in this is important when the reconciliation part comes across. Again, I'm wearing my auditor hat, so someone might ask, and it's a big question, that is there an audit opinion on MPMs? Let me address this very clearly. There is no separate audit opinion on MPMs. Okay. However, MPMs are disclosed in the financial statements, and auditors might need to take MPMs within their audit purview as well. And auditor will be checking whether the measures of the MPM come under the purview of the definition, like I mentioned in the beginning, that what comes under the definition and what does not. Whether the reconciliation that we just basically discussed is accurate, and whether explanations are reasonable and consistent as well. So, and again, obviously, the work of the auditor will be covered under the overall audit opinion of the financial statements itself. And like I said, just to reiterate, that will there be an audit opinion on the MPMs? No, there won't be an audit opinion in the auditor's report. And if basically something is missing in terms of the MPM disclosures, the auditor might basically check the compliance of it, and again report it in an audit findings itself. I will just quickly recap what we discussed in the previous slides, some of the important stuff. What is not included in an MPM? Any oral earnings call, any oral communication, any verbal presentation, any social media post. This is very important. These three headers, if you remember, obviously you can bifurcate what an MPM is, what an MPM is not. So now I think so. Let's hop the next slide.
Thank you, Amar. Very nicely explained. So I think we'll move on to the next slide after this. The effective date, we have a very few minutes left.
I think so. We can just quickly run through it. Like I said, that obviously some of the entities have early adopted it globally, but there are very few. Obviously, the mandatory annual reporting periods beginning on or after 1st January 2027. So again, the 27 year end will be the first full impact with the comparatives restated as well. Early adoption and application is permitted, but obviously you must need to disclose that fact within the financial statement itself. The transition is generally retrospective under IAS 8. What does that mean? Restatement of comparatives. And however, the IASB has provided some targeted reliefs to ease this burden, which are as follows. IASB tells us that no need to disclose the quantitative information related to nature and amount of adjustments for each financial line item under IAS 8. Okay, again, the first point is very important. The second being the mandatory reconciliation in the comparative between the old IAS 1 presentation and the IFRS 18 presentation. Okay, so this is again these three points are very important. And the last point is the undue cost or effort exemptions for certain reclassification of foreign exchange differences. Frankly speaking, practically from management perspective and from an audit perspective, many clients are targeting some dry runs within 2026 to test their systems as well and the classifications within the ERPs. And again, early adopters, we are also working with them to basically run through and so that everybody is ready when 2027 hits. So from my side, thank you once again, everybody. And I think so I'll pass on to my colleague Khushbu for the real world impacts and some examples just to enlighten us all. Thank you.
So thank you very much, Amar. Without further ado, what will be the impact on the real world? Okay, so as a preparer, you will have to undergo an implementation cost because you have to change your chart of accounts. You have to assess what is your main business activity that requires time, efforts, support from any external consultant, any expert, internal management discussions, then definitely discussions with your vendors as well as your banks, which I specified initially that your operating profit is going to be impacted. So all the discussions will take time, changes will take time, your implementation will of course take time. It's not 10 minutes things that you can just impose on when you're sitting and preparing the financial statement. It's high time you should start because there is the effective date is 1st January 2027. But if you have a complicated structure of your group or of your entity with different verticals within the same business, because your operations or your financial statement is not a reflection of your legal business activity as per your trade license, correct? So whatever is the underlying business, which is your core business activity, you have to identify that and then modify your financial statements or your chart of accounts according to this. That's why your implementation will take some time, efforts, and additional cost. What are the benefits for the users? As we explained earlier, the users can compare the financial statements much easily. They can take decisions appropriately. Like-to-like benchmarking can be done. And that's not always for the business, for the public entities. Even analysts, when they are preparing their analysis or research reports, when they are using or comparing different entities, with the same industries, just like myself, when we are doing valuations or we are doing, when we are identifying the multiples, we have to take the relevant entities. But if the operating profit or net profit or the calculations is not similar, the underlying line items are not similar, the numbers that we get might not be the correct reflection of the benchmark multiple, right? So it helps the users as well. Challenges, as Amar explained very well, MPM is one of the biggest challenge. Main business activity identification is another biggest challenge. That these are the two main things that I can think of right now, apart from all other supported or ancillary items. Broader effect, yes, your overall EBITDA might change, your EBIT might change, your operating profit might change, your policies needs to be aligned with the new IFRS. Everything will affect if your business is directly affected by this implementation. Apart from this, I would like to share few examples that I have come across. So usually there are businesses that has one or more activity in it. For example, a car manufacturing company, they manufacture car, they sell car, that is their core activity. But they are also financing the cars. So will that become an operational activity or will that be a part of financing activity? Now here comes an assessment. What is the core business activity of that entity? If these two verticals go side by side, then definitely both of them are a part of operating activity. But financing is one of or few instances happened, and as they are providing financing as an add-on support to their customers, then this will be classified in the financing activity. That's why I'm focusing or I'm asking everyone to do this assessment today so that by the end, you don't have to face the same issues. And if required, you need to change your policies. Yes, if you need to change your arrangement with your customers and vendors, you can do it now, right? Then there was another example that I came across was, for example, where do we charge our gain from the sale of property, plant and equipment? Usually it's the part of our operating profit, correct? Or sometimes, but in the cash flow, where is it shown? It is shown in the line item of investing activities, the sale proceeds. So there is a disconnect. But IFRS is very particular. It says that if your property, plant and equipment, the item that you are selling or disposing, can it generate revenue on its own or it cannot? Can it? Of course it cannot. It's a part of the entire PPE. That means it's a part of your operations. So whenever you are discarding or disposing of any PPE item, property, plant and equipment, you have to classify in your P&L as an operating activity, not as an investing activity. Then there is one more example. People ask me, what about banks? So banks operating activities are financing. So all the things related to their financial statement will be completely different. So their interest income, their their interest expenses, their finances, everything, they will not be classified in their financing activity. They will classify everything in their operating activity. So these are the 3-4 line items I can think of the examples. Yeah, one more example that is very important, which recently happened on one of our clients. Just think of a business who is providing or who owns investment properties. All the investment properties, their business is to hold investment properties and then lease out those investment properties. But these investment properties, where will you charge the fair value gain or loss on this property? As per this example, because their core business activity is holding investment property, earning rentals out of those investment properties, then the ultimate gain or loss of fair value on those investment property, provided those investment properties are carried at fair value, will also be charged to your operating activities and not your financing activities or investing activities or whatsoever. So there you have to consider what is the underlying activity whenever you are identifying or preparing your financial statements or identifying your line items, where to classify or which are line items. I can see a lot of questions here. We don't have much time to take individual questions, but as a summary, what I can say, identifying the underlying business activity. If anything, any line item is associated to that business activity, it should be charged to operating activities. Like I can see, Sarish, if you don't mind, I can just quickly take the questions or give a quick update on, because I've already responded few on the chats. But
Yes.
someone asked me that if there is a royalty related to a telecommunication service provider and we have to pay it to the government, then what will happen? Of course, this is an underlying activity of the operations. Then you should classify it into the operations. There is, because IFRS 18 is not something that you have to rethink on the criterias or recognition criteria. It's not changing the numbers, it's not changing the recognition criteria, it is not asking you to reevaluate anything. It's just asking you to present so that when the user is taking a decision, he knows that the operating profit includes every expense, income, levies, any royalties that is related to that particular operation. So this is very simple. Just remember the key thumb rule. Government grants, someone was asking me government grants. Of course, government grants is if it is linked to your business, if it is linked to your operations, and it is fulfilling the respective criteria of their respective standard, then it should be recognized in your operating activities. Then someone asked me that in 2024, ICAP issued ICAP guidelines for levies. Levies is again, if it is linked to your operations, then please consider the underlying asset or liability or operation or the activity which it is being generated for or issued to or applied to the entity. Recognize it in your operations. If it is not related to your main business activity, then think about where else it should be classified. So just keep a thumb rule. Just understand that. That's nothing very complicated. And someone is asking me, what about IFRS 10 implications? Will that change? Again, IFRS 10 is specifying the recognition criteria. It has some exceptions. Yes, if you are fulfilling those exceptions, nothing will change. But if you are not fulfilling those exceptions, follow the base IFRS or IAS rather than considering IFRS 18 first. IFRS 18 is just a presentation. It's not changing the criteria of recognition of any line item for you. So I think we have responded to most of the questions and given a little bit highlight about what happens in the real world. So one
Yes, thank you,
advice
Khushbu.
from
You
me.
have covered all the questions very nicely. I would like to thank all the speakers today for your valuable insights. You have very nicely explained in detail IFRS 18, its impact, and how it's adding value for all the users. And I would also like to appreciate and thank our attendees for taking time and attending the session. And we offer financial advisory service for early adoption of IFRS 18. And we as ANG Chartered Accountants, we are also providing assurance service. We are registered in JAVSA, IFZA, DCC, DMCC, RAKES, TWTC, Medan, and DSO. Thank you again. And if you have any more questions, you can email us at heretohelp@athgadlang.com. Thank you once again for your time.
Thank you, everyone. Take care. Bye-bye.
Thank you, everybody. Bye-bye.
Bye. Assalam.